All right, let's talk about the one company that is on everybody's mind right now, NVIDIA. I mean, they're at the absolute epicenter of this whole AI revolution. No question about it. And the reason why is, well, it really just boils down to this one number. In their last quarter, NVIDIA's revenue shot up by a staggering 55.6% compared to the year before. You know, that's not just growth. That's like a tidal wave of demand changing the world. So, that brings us to the big question, right? We all get it. The company is incredible, but is the stock a good investment to make today? That's what we're going to try and figure out, and we're using a really detailed investment report to guide us. So first things first, before we can even think about where NVIDIA is going, we've got to get a grip on the phenomenal performance that's happening right now. And when it comes to that, well, the numbers really don't lie.
And listen, that huge revenue number, it's not just for headlines. It's dropping straight to the bottom line. Their operating profit jumped over 52% year over year. That's the sign of a serious earnings engine. And this isn't some accounting trick or paper profit, you know? We're talking about cold, hard cash. The company's free cash flow, the actual money it's generating, grew by almost 40% in just 6 months. That's real money flooding into the business.
Okay, so let's pull all of this together for a second. You've got massive growth in revenue, massive growth in profits, and it's gushing cash. But look at that operating margin, 60.8%. That is just unheard of. It tells you they have a powerful competitive advantage. They can basically charge what they want. All right, so the performance is obviously off the charts. But is this whole thing built on a solid foundation, or is it a house of cards? Let's do a quick financial health checkup and see.
Check out the company's liquidity ratio. This is basically a measure of its ability to pay its bills. It's at 4.21. Now, for context, anything over 2 is considered excellent. This is like going to the doctor for a checkup and getting a perfect bill of health. They can cover their immediate bills 4 times over without even breaking a sweat.
And just look at this comparison. I mean, seriously, they've got about $8.5 billion in long-term debt. Now, that might sound like a lot to you and me, but when you compare it to the $78 billion in net working capital they have on hand, it's a drop in the bucket. It's nothing. That debt is so manageable. So, the final word from the report on this? It's simple. NVIDIA isn't just healthy, it's a financial fortress. Super conservative, incredibly robust, it is built to last. Okay, so, phenomenal business, rock-solid finances. This has got to be a slam dunk, right? Well, hold on. This is where the story starts to get a lot more complicated.
On one side of the ring, you've got the company's own leader, CEO Jensen Huang. And he's not just talking about growth. He's painting this picture of a whole new industrial revolution, a market worth $3 to $4 trillion. Trillion with a T. That's the hype. But then you look at what the market is actually expecting. This is the reality. Take a look at these analyst forecasts. Yeah, the numbers are still good. I mean, they're great for any other company. But do you see what's happening? They're predicting a major slowdown, with revenue growth getting cut almost in half in just 2 years.
And this, right here, is the central problem for anyone looking to invest. You've got the CEO talking about a revolution that's just getting started, and then you have the professional analysts who are basically saying, hey, the law of large numbers is real. A company this huge just can't keep growing at this insane pace forever.
You know, a great way to picture this is to think of Mr. Market as a person. Right now, he is absolutely in love with NVIDIA's latest report card. Just euphoric. But when he looks down the road, 2, 3 years from now, he gets nervous. He's skeptical. And you can see that split personality right here in the stock's valuation. This is its price to earnings ratio. Basically, how much you're paying for each dollar of profit. And at nearly 54 times earnings, it's way above its historical average. What that means is the market is already expecting absolute perfection. So this is the big question we have to answer, isn't it? Given this huge conflict between the revolutionary hype and the market skepticism, what kind of future are you actually buying with today's stock price?
Which brings us to our final section, the verdict. We're going to walk through the report's own valuation to see if we can figure out a realistic return from here. Now, this might look a little intimidating, but it's actually super simple. Stick with me. First, we just take those analyst forecasts for earnings. That gets us to about $5.19 per share in 2 years. Then, step 2, we apply a PE multiple. And to be safe, we're going to use one that's below the historical average. This builds in a little cushion, a margin of safety. Multiply those two numbers, and you get a target price of around $181. From there, we figure out the return. Simple, right?
And here's the number that calculation spits out. Based on this pretty realistic, even conservative projection, the potential annualized return for the next 2 years is just 3.9%. I mean, let that sink in for a second. After all that incredible growth, the future return baked into the price is less than 4% a year.
So let's just run down the final scorecard here. Is NVIDIA an exceptional business? Yes, check. A promising future? Absolutely, check. But an attractive potential return at this price? The analysis says no. And is there a margin of safety? Definitely not. The verdict is clear, the price is just too steep.
And honestly, this quote from the report just nails it. NVIDIA is an exceptional business, but at the current price, Mr. Market discounts a future of near perfection. It couldn't be said any better.
So that's the dilemma, isn't it? You have this incredible, world-changing company, but it's trading at a price that demands absolute perfection. The real question you have to ask yourself is, does that potential return, that tiny 3.9%, really justify the massive risk if things aren't absolutely perfect?